So review the book or check the worksheet that I provided and look at the income statement for Stanford. You'll see the 365, and that gets split 80-20 between the two. Dividends, those also are coming from the financial statements that were provided, and those are 50 for Stanford, split 80-20. And then the excess, well, the property, plant, and equipment has an 8-year life, so divided by 8 will be 5. And then the patent has a 14-year life, divided by 140 divided by 14 is 10 per year. I like those nice even numbers. So you've got $15,000 total in excess fair value. Keep in mind the trade name has an indefinite life, so it's like land. We won't amortize it, but should it become impaired, then we would write it off, similar to goodwill. And that $15,000 gets split 80-20. We get our totals at the end. So we've got a bunch of check figures, and we know that goodwill is going to show up at 232. We know the patent is going to be adjusted for 130, the trade name for 23, plant and equipment for 35. Just gives you some numbers to work with. But because this is a full consolidation, we also want to make sure we do all the appropriate general journal entries so that we can justify and explain where all the numbers come from in our financials. And anything in this column here is what we would be journalizing in the parent's general journal. Everything that happens to the non-controlling interest, while it's all the same items, just a smaller percent, all that gets handled in the consolidation process. So pulling this forward to the next slide, everything that we see there in coral would be journalized. So we purchased the Stanford, we received income from them, we received dividends from them, and we adjusted for the excess fair market value items. You should probably be pretty good at making the journal entries at this point. The harder part now is this next step. And this is where we have to do the consolidation. Now, on this slide, I can't have all the information, so hopefully you have your chart with you. You have your financials. And then I did want to really quick point out, see, this is where I got the 365 in income and for dividends, to help you facilitate the process. Okay, we do all the standard consolidation entries. We start with book value. We adjust for the income, equity, net income, and dividends paid to the parent. We do the fair market value adjustments to the beginning of the year, and then we amortize them for the current year in the consolidation worksheets. So it's a lot going on, but if you remember, it's just that same pattern every time. You'll get good at it. So entry 1 is the equity accounts. In this case, you've got capital stock of 120, additional paid in capital of 40, and then the retained earnings, remember that always comes from 1-1. Capital stock, retained earnings, additional paid in capital. Now the total of this what, 690, gets split between the parent and the non-controlling interest, and it's split based on their ownership percentage. So your credits will be 80% investment, 20% non-controlling interest. Okay, because both the parent and the non-controlling interest have a proportionate share in the book value of Stanford. So that's entry 1, relates to both. Entry 2, though, only relates to the parent, and that's the income, the equity net income that's recorded in the individual statement of Plaza, and then the dividends paid to the parent, because those need to be eliminated. The dividends paid to the subsidiary, or to the non-controlling interest, that the subsidiary pays to the non-controlling interest, those will be adjusted for in calculating the non-controlling interest at the end. So we've got equity net income of 280. That's here. You can also pull that from your chart. It's the 80% of income minus 80% of excess. The dividends paid to the parent, well, it's not the full 50 here. So you have to go back to the chart and see that you received 40. And then the investment account is the plug figure on this entry. Third consolidated entry is the fair market value adjustments at the beginning of the current year, which it's the first year we've owned them, so it'd be the beginning of the year that we own them. And this is where your chart again comes in handy. You've got trade names at 23 at this point, property and equipment for 40, a patent for 140, and goodwill for 232. And these again are all items that are split proportionately between the parent company and the non-controlling interest. Now keep in mind, we say that now with goodwill, but there will be circumstances that there might not be that same split in goodwill. You're not going to run into them in this class in the problems I've assigned. You'll see it in some of the other problems. It's a little bit more complex, so we're not going to, I want you to be solid with your foundation before you move on to that topic. But at any rate, adjust to the fair market value at the beginning of the year. Divide that based on ownership percentage between the investment and the non-controlling interest. And then last thing, as always, we take amortization of the excess fair market value. So there's depreciation of 5 on the equipment, building, and amortization on the patent. And you've got all the basic entries. Now I also like to keep tabs in this list so that I can check them all off when I move them into the worksheet. The non-controlling interest amounts that are going to show up. And the non-controlling interest in net income, if you go back to the chart, is the 20% of income minus 20% of excess. And then they were paid dividends of 10. Now, everything you see here has to end up in these working papers here, in these debit and credit columns, or in this case, these will go directly into the consolidated columns. So we need to move all our debits and credits where they belong into the worksheet. And I've color-coded them so you can find them a little more easily. But there's all your debits. So you've got some depreciation and amortization. You've zeroed out the equity net income, so this will end up being a 0. This just adds to your depreciation and amortization. Zeroed out the beginning retained earnings. You've zeroed out the capital stock and additional paid in capital of the subsidiary. And you've adjusted all your fair market value assets, or assets that are book value, to their fair value, including goodwill. On the credit side, we move all those in. We've gotten rid of a portion. Remember, this is a portion of the dividends, but the other portion is going to end up here. We've got credits for the investment account to zero that out. So this, by the time you've gotten all these in there, should zero out. We're getting the fair values to the end of the year values. And we've also established here our beginning non-controlling interest balance through all these entries. Okay, now we can start adding across. We add across the sales, we add across the cost of goods sold, depreciation, amortization. And we have, when we then add those vertically, 648 for consolidated net income. So that's the consolidated net income. Then we know that our non-controlling interest in net income is 70, because we know that this consolidated net income has to total the sum of the non-controlling interest and controlling interest. So that we've calculated the non-controlling interest, leaving us with 578 for the controlling interest. And because we've used the equity method, this number ties to this number. Okay, so just remember that the consolidated net income has 2 parts to it. The part that belongs to the non-controlling interest and the part that belongs to the controlling interest. However, it's not 20% of the total going to the non-controlling interest, because the non-controlling interest only shares in the income of Stanford, not the company as a whole. Okay, and that's why we have these numbers identified so that we can pull those out. Now, incomes feed into retained earnings statements. So you're going to see the 578 feed into the retained earnings statement of the parent company. The 70 will feed into the equity position of the non-controlling interest. So we add across our retained earnings, we've zeroed out the parent or the Stanford, so we've got 1275. Pull in income. Dividends would be just from the parent. Keep in mind that while we've eliminated 40, the extra 10 doesn't add across. It's going to add down into the non-controlling interest. Then to do the non-controlling interest, the 138 plus the 87, adding those together, you've got 225. That's your beginning balance in that account. You add in the income of 70, you pick up the extra 10 in dividends, and your ending balance is 285, which you know from your chart that that's what it's going to be. But that's where all the numbers come from in the process. Okay, this is the most confusing part. I think the book's even more confusing by creating another column that's neither a debit nor a credit. But if that works for you, great. But I like treating it as another retained earnings type account, but it belongs to the non-controlling interest. Because both of these will then be pulled into the equity section. But before then, we add across all our assets. Once we have all our assets added across, we total them, because remember, we don't add those together. We total vertically. We do the same thing with our liabilities, and then the retained earnings comes from our retained earnings statement. The non-controlling interest, that came from the statement we created for the non-controlling interest. And you've consolidated another first year acquisition where we have a non-controlling interest present. It's overwhelming. Maybe take a little break. 7th-inning stretch time in baseball terms. But hopefully you understand enough that when you do the next problem, which is adding another year's time to it, you'll feel comfortable putting it all together. And it will get easier as you do more of these. Okay, let's start on problem 32. 32 is another situation where we're purchasing less than 100%. We're going to make the purchase in 23, but then we end up preparing financial statements for 24. There's a lot of information for this problem, so you're going to need the worksheet and your homework section open because I can't get it all on these slides. But we're going to do the same exact pattern we did in the previous problem, where we calculate the non-controlling interest based on the implied value of our purchase so that we can set up our reconciliation chart, only we're going to have to do it for 2 years. And so we've got a lot of information we're going to need. Okay, so here we've got applied value, $1,710,000 is what we paid for 90% interest. That's worth $1,900,000 overall. Okay, unlike the previous problem, they didn't give us that, so we calculated that. The non-controlling interest then would be the difference between that implied value of 100% and what we paid for 90%, so 190. Then we can set up the chart. So we paid 170, that goes into our investment account. That'll be a general journal entry. Non-controlling interest we have to establish and just keep track in this worksheet for the consolidation process. The book value when we acquired them is $725. We've got this software with a fair value of $800,000, 10-year remaining life, and then anything else would be goodwill. So in this case, that will be $375. Okay, then over the course of the year, you would typically adjust for income and dividends and excess fair market value. However, they didn't give you in this problem the income and dividends for 2023. So all you can do is go to the financial statement. So look at the income statement and balance sheet of Stein that's provided in the problem. Now go and find the capital stock, and you should see 400. You should see additional paid in capital of 60. So you're up to 460 for their book value. And then in the 2024 financials, you have beginning retained earnings. So that would be the equivalent of retained earnings at the end of 23. So that was 395. So look in the retained earnings statement for that. And then add to that the 400 and the 60 that you had for stock and additional paid in capital. That'll give you that ending balance. We'll come back to that excess of 855. Okay, so that's where we ended 2023 or started 2024. The difference between the 855 and the 725 is 130, and that's the net income less any dividends paid. You have to do the same sort of thing in your Excel assignment, that you won't know the income and dividends for the first year, but you will be able to figure out where you ended with book value and compare it to the beginning of the year to get that amount. I know that sounds confusing, but remember, this amount here is in the 2024 financials. It's beginning retained earnings plus common stock plus additional paid-in capital if it exists. And that's where the 855 came from. So the difference between what you started the year in and what you ended would be the income minus dividends. Now this excess was just the software being amortized over 10 years. So that's when you divide that by 10, that's 80. And that gives you split 90, 10, 72, and 8. This 130 we've calculated for income less any adjustment for dividends would be split 90, 10 as well. So 117 and 13. And we would start 2024 with 1755 in the investment account, a non-controlling interest value of 195, 855 in book value, 720 left on the software, and there was no goodwill impairment, so that's still stuck out there at 375. Now this year, we will be able to identify the income, dividends, and excess because that's given in the worksheet that you were provided. Okay? So you have that they earn $215 in income, and that gets split 90-10 because that's in their income statement for the current year. You also know that they paid $25 in dividends. It's in their current year financial statements. And then you've got that software being amortized, another 80 for another year, split 90-10. And when you add this now in total, it starts here and goes here. This was 80. It's always hard to tell in these boxes when one's coded and one's not. That's your dividing line. This was end of 23 becomes 1/1/24, and we ended with 1854, which you should see in the balance sheet of Perlman. The non-controlling interest 206, that will end up in the equity section of the consolidated financial statements. The book value of 1,045 is what you should see in the work papers for any book value. So that's the capital stock, additional paid-in capital, and the ending retained earnings. That the 1,045 comes from the balance sheet. Software's down to 640, and again, no goodwill impairment in year 2, so we're at 375. Do know that general journal entries will be made for the items in the investment column only, and we'll quickly do those for year 2. And because it's year 2, we do not have to record the initial investment. All we record in year 2 are the adjustments to the current balance. And so that's the income, the dividends, and the excess fair market value. Okay? Now comes the trickier part, doing the consolidation. Same pattern as always. We start with the equity accounts of the sub. And they have capital stock, additional paid-in capital, and beginning retained earnings. So all 3 of those will be adjusted outward. And those belong to both the controlling and non-controlling interest. So that entry, the credit side, gets split. In this case, it's a 90-10 split based on their ownership percentage. Second entry is the income, equity net income, and dividends paid to P. So this is a parent-only entry, and we'll pick up the equity net income from the income statement, and then the dividends you would have from the chart from this year. So that would be 90% of the 25 that they paid. And the difference is the investment account. Third entry comes straight from the chart again, and that is adjusting your excess fair market values to their value at the beginning of this current year. So we start with the 1/1/24 fair market values. Software at that point was down to 720. Goodwill is still at 375. And those get split 90-10 between the controlling and non-controlling interest. So they come out of the investment account, and they're setting up essentially your non-controlling interest value. Last entry is to take that amortization of that software for 80 for the current year to make sure that you adjust your income statement for the fair value amortization, not book value. I like to personally take note that my non-controlling interest in net income will be their 10% of income minus 10% of the excess fair market value, and then the non-controlling interest in dividends is 10% in dividends. We take all of these items and add them, all the debits and credits, to our financial statements, and I have them in color coded so you can hit pause and see where they all came from. Once you have them all transferred and know, beginning retained earnings, the tricky one here is that our non-controlling interest has its own kind of equity or retained earnings kind of statement where we're building up the value in that account. Then we can start adding across. So our total sales, our total cost of sales, our total depreciation, total amortization. Notice the equity net income zeroes out. This problem just had a lot of categories. When you sum those all together, your consolidated net income is $40,000.5. That gets split between the two, but it's not a 90-10 split because we know the non-controlling interest in net income is $13.5, and then everything else would go to the parent company. And that should match what you have recorded individually by Perlman. Incomes get fed into the retained earnings statements. So the 437 will be added to the beginning retained earnings, added across. Those zero out, so you have 2006.25. Income comes from above, and that's the parent portion. The other 13.5 is going to come down here and show up in the non-controlling interest portion. Dividends, again, we're just going to pull over the parents in the parents' retained earnings statement. We eliminate 22.5, but the other 2.5 we know are going to show up again down here in the non-controlling interest statement. So we end the year with retained earnings for the consolidated group of 2007-12, which matches what's in the parents' records. The non-controlling interest doesn't exist on the book, so we have to create that. And so our beginning values, the 109.5 and the 85.5, add up to 195. We pull down the income from the income statement, 13.5, and the dividends from the dividends paid by Stein, 2.5, and we end the year at 206, which should match exactly what's in your chart. Once you have these numbers, these are going to end up showing up in the equity section of your balance sheet. The rest of your balance sheet can be just added across. Okay, so you're adding across current assets, the investment account zeroes out, you're adding across the software that doesn't exist on the books but is part of the fair value of the company. Once you have all the individual items, add them up and you have 5,500. Your payables come across, capital stock, these zero out, so it's 900 and 300 that the parent has for capital stock and additional paid in capital. And then the non-controlling interest, that gets fed from the statement above, the 206. The retained earnings balance gets fed from the statement above, the 2007-12, and you have 5,500. Okay, I'm sure if you go through this just one more time, you're going to have it nailed. If you have any questions, please feel free to contact me. And hang in there, because you've got this, you really, really do. In this video, I'm going to work 2 homework problems and their full consolidation. So it's going to take a little longer than some of the other videos. You will need both your textbook with the homework problems open, and you probably will want the worksheets, the Excel spreadsheets that I've provided in the Canvas website. So go ahead and grab those for problem 23 and 32. The first problem, 23, will be the consolidation at the end of the first year after we've acquired a company, and then 32 will be the second year after. So it'll be just a little bit longer, a little bit more calculations. So let's start though with the simple one. Plaza acquiring 80% of Stanford for $900,000 cash. On the date, the total fair value, including the non-controlling interest, is $1,125,000. We can also get that by calculating the implied value, which we will do in just a second. Book value is $690,000, and then we have some individual items provided in the problem with fair values different than their book values. So step 1, let's go ahead and just calculate. Our implied value is $900,000 divided by 0.8 is $1,125,000. They gave it to you, so you wouldn't necessarily have to do this. I just think it's a good practice. So that means our non-controlling interest, when you take the $1,125,000 minus $900,000, is $225,000. Okay, now we have everything we need to set up our reconciliation chart. So we know that on the date we acquired them, the investment's going to be $1,120,000. It's going to be $900,000. The non-controlling interest will be the $225,000. So together, these will total the $1,125,000. Book value is given, that's $690,000, and then all these excess fair market value items, trade names, is just the difference between book value and fair value. So when you subtract, take 383 from 360, that'll give you 23 for the trade value, or for the trade name, which has an indefinite life. We've got $40,000 on the property, plant, and equipment to go from 290 to 330, and then for the patent to go from 132 to 272, that difference is $140,000. So filling all those in, you can then total all of these to see how it compares to the $1,125,000. And you're going to find your fair value is short and your goodwill, then the plug figure to make this balance is $232,000. Now we're using the equity method, so we're doing everything we had done before. We're adjusting for income, which gets split.